Hello, good afternoon, or good afternoon, or something. Good morning. I just totally forgot where are we at right now.
5 o'clock somewhere, right?
So thank you for joining us today. This is AI Research Networking Series. In this series, we are hoping to create a collaborative environment that people can explore AI research in a multidisciplinary sense. We have a couple of different purposes of this event, but one of them is to highlight the great work that our faculty members conducting and doing in Ilan University. And hopefully we are hoping to create interdisciplinary, multidisciplinary dialogue and how AI can be integrated and tested in different contexts and discipline. Also, we have a very ambitious goal. This semester and next semester, we are seeking some AI grant from different institutions and different foundations. This research networking event going to provide us a baseline or starting point to put our AI researcher in a team to seek for $1 million, $2 million, and sometimes, if why not, $10 million grant. Indeed, when you look at that, these are the recent research grants provided to different institutions. And look at this example. I like to highlight that one. AI Institution for Engaged Learning from North Carolina State University. And they receive almost, if I'm not wrong, $15 million for their AI research networking event or institution. So first, they got our name, am I right? Engaged Learning belongs to us. We are famous for it. The second, they did it. Why not? We are putting some efforts to seek for similar initiative. So this semester, we are going to prepare and apply during the summer. If you're interested in, please let us know and you can join. And that is to say, also we have an AI pedagogy challenge. If you haven't applied, please consider sending your application. Thibaut recently just received something, am I right? You just selected
right,
top 50. And Israel Valderes from Communication School, he received some top applications. So that is, these are our listed following presentation. If any of them interest of you, please consider joining us. We are going to have a series of interdisciplinary talk going on. And that is to say, let me introduce our today's guest speakers. Dr. Thibaut Morillon, recent associate professor of finance at Ilan Law School of Business, specialized in financial technology, particularly blockchain and cryptocurrencies. His research includes analyzing Bitcoins and stock flow models, exploring how AI and machine learning shape financial decision making. He teaches courses on fintechs and other financial technologies and finance courses. And my takeaway, if you're interested in blockchain and Bitcoin and learn some financial technologies, he's the person, he's the expert. You should talk about it. It might be you're going to get rich, am I right, in terms of knowledge. All right, please join me welcoming Dr. Thibaut.
All right, guys. Well, first of all, thank you so much, Moose, for having me here, and thank you, everybody, for taking the time out of your day to come and see my presentation. I very much appreciate it. So right there in the middle, let me just put that full screen. So there you go. Fantastic. Well, thank you, everybody, for being here. So I'm Dr. Morillon. Thank you so much, Moose, for having me here. This is going to be my paper, predicting Bitcoin returns with machine learning, right? So when Moose told me that he needed someone to come here, thank you, and present. Is it better for you guys like this? Okay, good. And present my AI-related work. So I'm currently working on a bunch of AI-related papers, some in the field of real estate, some in more traditional finance. But I felt that since I'm so interested into anything that involves Bitcoin, cryptocurrencies, and AI, it seemed to me like this was the perfect blend and the perfect crowd to kind of present that. So I think it's kind of an interesting thing. And so what I decided to do is to take a look at whether or not we could actually predict Bitcoin return using machine learning algorithm, meaning going a little bit beyond those traditional financial models we're used to using in traditional finance. So with that being said, right, why would we do this? So I'm not going to bore you to death with all of these details. I'm sure you guys can all see the point, right? Bitcoin specifically is an asset that is known for being extremely volatile, right? I'm sure everybody by now in the world probably knows about that at the very least. And so that makes it a very interesting asset to focus on, right? You were talking about becoming rich, right? Of course, right? Don't we all want to make a few bucks? And so I guess that's to a degree what makes these types of assets, talking about cryptocurrencies, very interesting because you can make a quick buck. You can also lose a lot of money, believe me on that. So, you know, it's kind of it's a two-way street. So the idea here is to see if we can actually develop predictive models, right, that are actually efficient when it comes to cryptocurrencies. So now I was wondering how to put up my presentation together because, you know, when you do things in an academic setting, you need to present your literature review and everything, and it usually takes 45 minutes of just the review, and I'm going to be honest, everybody's bored to death and is snoozing on their table, right? So I'm going to try to skip over that very quickly, and in order to do this, I'm actually going to mostly refer, we need to give credit where credit is due, to Wu and al. It's a team of super interesting researchers, and they actually saved my life because late last year, they popped this paper, which is a literature review of everything that has been done in the realm of cryptocurrencies and machine learning algorithms. So I gave it a big old hallelujah when that paper got out because it saved me hours, of course, of doing research and essentially just laying down what everybody has done in the past. And so what I've done is that, you know what they say, if someone has said something very well, there is no need to reinvent the wheel, just borrow their work and make sure to cite them. Of course, that's true, especially for you students, right? Never forget the cite, right? And so what I've done essentially is come up with the literature review of Wu and al. Right here. So I just popped all of their tables, right? As you can see, they have literally 3 tables filled with existing papers that deal with that very specific topic. So cryptocurrencies and machine learning algorithm. That kind of provides a really great summary of what has been done. So I felt it was probably better to just kind of show that to you guys, right? So we can all get an idea of what's been done. And so when it comes to what has been done, as you can see here, you have a few columns. You can see that a lot of work has been done on pretty much just about any major cryptocurrency under the sun. So not only Bitcoin, but also Ethereum, Cardano, Monero, Litecoin, Ripple, you name it, it's probably has been done before. You know, various different windows have been tried, various different models have been tried, various different success or performance metric have been used. This is kind of what I wanted to use these tables for, right? And so kind of the point of doing this is kind of, again, to borrow their quote, although various deep learning models have been explored for cryptocurrency price forecasting, it is not clear which models are suitable. And after going through every single one of them one by one, I would say that this is actually even an understatement, right? So whenever you come up with a paper, like part of the game is to kind of try to position that paper. How are you going to sell its story? And so mine is actually, I think, fairly simple. What I'm saying is the following. Lots of work has been done, but it's extremely inconsistent, right? What are we predicting? Are we predicting price? Are we predicting returns? Are we predicting trends? Are we predicting volatility, right? There is a little bit of everything everywhere. What cryptocurrency are we focusing on? Are we trying to predict the price 3 months from now, tomorrow, within 5 minutes, right? There's a little bit of everything that has been done using various different models. And the point is that it seems to me that very often kind of what happens is that, I don't know, some researchers develop some expertise into the fancy latest school model and decided, well, how about we try to predict Bitcoin price, right? Or something along these lines. So it's interesting, right? I'm not taking anything away. It's a very interesting, venture, but my look into it was simply, okay, we have a lot of different various studies with various models and whatnot, but it doesn't really seem there is a continuous idea into all of it. And so what I would want it to do is say, all right, how can we frame the research question? What is it interesting for us to do? And so I decided to just simply take a step back and try to look at it really from a purely agnostic perspective. And so I thought about essentially saying, can we predict Bitcoin return tomorrow using a slew of different models. So some would argue it's better to have deep learning models. Some would tell you, okay, just tree-based models are better. How about we just use classic OLS regression? My take on this is to say, how about we try all of them in a very specific setting, trying to do one very specific thing, which is predict Bitcoin returns tomorrow. So that's kind of the idea. Yes?
I have a question. In terms of target predictions, you just look at all of those target predictions. There is a future price.
Yes.
Am I right? Close price, short-term or long-term pricing, or other returns, and so on. So when I consider AI from agentic perspective, AI as an agent, that AI agent, try to provide some different dimension. AI agent doesn't predict the price of the market, but it predicts whether it's going to sell or buy. Is there any work has been done, sell or buy previously?
Yeah, so that's actually exactly where I'm getting into. That's kind of the angle I'm going to take. Precisely, your argument is excellent. That's actually, you're stealing my thunder. This is pretty much exactly what I was going to go for. You're absolutely correct, right? What are we going to do? Are we going to predict something? It seems to me that pretty much this taking it at, is it going to be a buy or a sell, green or red? What I call the green or red approach, I think is very well suited for what AI does, right? And so precisely, that's an excellent point, because so I gave you kind of the very brief rundown, but precisely, you're absolutely correct. Let's say you're trying to predict price. What are we doing here? Predicting price tomorrow, predicting price 5 months from now. Those are two vastly different exercises, right, as you might imagine. And so the degree, right, the quality of the performance of their models varies tremendously depending on just the window. So for example, those very, very, very short-term studies that try to predict the price of Bitcoin within the next minute or the next 5 minutes usually they're starting to be somewhat decent at predicting that. They're actually nearing even 60%, because if you think about it, it's an up-down, right? So 60%, if you can predict something that goes up or down 60% of the time, it's fantastic, right? You're probably going to make a lot of money. They're not quite at 60, but 58 or something like that, which is very high. Now, when it comes to predicting price in the future or whatnot, you would see wild discrepancies among these papers, and that's precisely my point. It seems like it's all over the place, pretty much. And so I think part of it is because of how we define the goal and the objective. So thank you for that comment. You're right, this is kind of exactly where I was getting at. My angle here is going to be, okay, can I predict Bitcoin returns tomorrow? So how do I define returns? This is pretty much the question you alluded at. So you take essentially pretty much, let's say, the closing price. So there really isn't any closing price at Bitcoin. It's open 24/7. It's not like the traditional financial market. So it's not like you can take the price at 4 p.m. or whatnot, but essentially you take it at a given point in time every day, right? 00 UTC, for example, doesn't really matter what the price is. And you essentially, this is kind of what you see here, right? Price tomorrow minus price today, same time, same hour, and that gives you essentially your return. And so the idea is to say, all right, can I simply take a bunch of predictors today to predict returns tomorrow? That's pretty much, so the timeliness of everything is of course key. You need to have that. That's the reason why you take the returns, the vector of predictors, you take it as of today, because it needs to be available at time t to predict returns the next day. Does that make sense? I think it's a pretty fair setting. I try to essentially write it down like this. I know it sounds kind of like a nerdy, that I made it like more complicated than it needs to be, but the point is that since I'm going to involve a bunch of models with non-linear essentially factors, you can't really write that as the classic y equals mx plus b, right? Mathematically, that wouldn't quite exactly be correct. So long story short, it's kind of a nerdy way to put down, can I predict return tomorrow with my set of predictors today? That's kind of essentially the idea. Okay, so now, why is it interesting and why is Bitcoin such a fascinating asset? So essentially here you can see the basic price chart for Bitcoin, which I'm sure you have probably seen, which kind of looks like almost kind of an exponential curve right here with quite a few up or downs. I guess taking the log returns is probably a better way to actually make my argument, which is that if you take a look at it, right? So I'm going to just get sidetracked for a minute and kind of explain why Bitcoin is so fascinating to most people. So if you take a look at the log returns right here, you could see right here, I essentially colored the quote-unquote bull market and bear market in red and green, right? So everybody can see. So I'm sure you guys all get the idea, going up, going down. That's pretty fairly basic. What is very interesting in here is to see how almost, how cyclical it seems that the asset is, right? In terms of bull and bear markets, centered around those black, dark vertical lines that you see. And so these black, dark vertical lines, I did not just put them in there randomly just because they look good. There is a purpose for them. They are actually symbolizing what we call the halving for Bitcoin. So are you guys somewhat familiar with what that is? I'm seeing quite a few heads shaking yes, some other eyebrows raising. So that might not necessarily be pretty obvious to everybody. But so just for a quick minute to explain how Bitcoin works, part of the reason why it is so attractive to so many investors is because it has a fixed hard-coded supply, right? In other words, there will never be more than 21 million Bitcoin out there in circulation. Do you guys know how many of them have been minted as of today? 20 million already, and the last one will be minted in about 2140, right? So essentially, we've minted already the bulk of it, and thus far, and all the way for the next century, right? If it still exists there, we'll see about that. We're still going to have an ever-decreasing number of Bitcoin entering the supply. Why? Well, because the only way you have to create new Bitcoin is to mine them. Okay, so that's where we include miners into the talk. I will not bore you to death with the math behind miners and what they do, but I'm sure you guys have heard about them. They're roughly speaking, kind of the guardians of the galaxy of the Bitcoin network. I guess that's kind of a good way to put it. And so what they do is put transactions into blocks, mine blocks, so that way we can see every single transactions online at any given point in time. So why are they doing this? Well, because they have a financial incentive in doing so, right? In other words, they receive a certain number of Bitcoin for each block that they mine. And then when it comes to Bitcoin, you mine a block every 10 minutes. It is hard-coded, so a block of Bitcoin is mined every 10 minutes, and it works like clockwork. So technically, it's not every 10 minutes, it's about every 420,000 blocks, which amounts to, if you do the math, roughly a block every 10 minutes. So now that we've nailed that the nerdy part out, right? So why are they doing this? Because they receive a reward every time they do. So it started when Bitcoin's inception in 2009 came around. So it was 50 Bitcoin per block. So we're nearing about $100,000 per Bitcoin today. So if you guys are good at math, it's like roughly about $5 million in today's dollars per block mined every 10 minutes. So I'm sure you're starting to see why this is attractive to so many of them. And every 4 years, that reward is halving, right? So in here we have 2.25, 12.5, 6.25, and now we're at 3.125, whatever that is. So you get the idea. It gets halved every day. Why is it attractive? Well, because we know what the Bitcoin's growth rate in terms of supply, right, will look like over the next century. In fact, this is kind of what we call disinflationary, which means that it keeps on growing, but at an ever slower rate. That is partly what is so interesting to investors. They're saying, okay, so I'm not going to get into like weird conspiracy theory about debasing the dollar or whatnot, which I'm sure you've all heard on TV or whatnot. But the point is that if you're afraid of that, whether or not it justifies a different story, but the point is that if you're afraid of that, an asset with a hard cap all of a sudden is probably very interesting to you. And what we observe here, especially it's pretty obvious when you put in on a log scale, is that it seems that there is this kind of like cycle that is repeating centered around these halving events. It's kind of a very interesting thing to observe. So, case in point, if we're looking at prices, we see why it's kind of an ever-increasing proposition. If we look at returns, this is what Bitcoin returns look like right on a daily basis. So back to our point about whether we should predict trends, returns, prices, I'm sure all of a sudden it makes a little bit more sense why you would focus on returns. They are much more what we call stationary, right? Obviously, if you're trying to predict price over something that grows like, on almost an exponential rate, you're probably setting yourself in a tough situation, right? Because you have an increasingly high growth rate. It's very hard to model. Point is, returns are far more stationary. It is kind of easier to do. It makes more sense if your goal is to try to predict something. That being said, what's the downside of that is that you can see that this is a very highly volatile asset. For those of you guys that are familiar with traditional finance, we kind of rarely see day where an asset loses with 55% or whatnot. That's pretty fairly uncommon in traditional finance. We'd probably see a wave of suicide if something like that were to happen, right? So needless to say that everything that happens in the world of crypto is to a degree, as I like to say, works similarly to the traditional stock market, but on steroids. Everything goes faster. So that makes it also much harder to predict, as you might imagine. And so this is where I'm trying to kind of come up with an interesting setup that is going to add value and add something that hasn't been done before. So what am I trying to do? Like I said, I'm going to use a bunch of different models to try to use existing data to predict Bitcoin price. That is a pretty fairly, I believe, common setting, to say the least. And so the idea here is to grab all of the data that I have. Sorry, just a minute, and making sure I have the timer around, make sure that I don't overstep my limit. The idea here is, okay, I have about 12 years worth of data, in fact, exactly 12 years worth of data, from January 1st, 2013, all the way to December 31st, 2024. And so what you do is you grab part of that data, you create a training data set with this. So it's going to be roughly my first 10 years worth of data. And then you use that to create a prediction model, which you then use to forecast the first return on the first day of the test data set. That's kind of roughly the idea, right? So once you've done that, let's say we use let's start with a very classic example, or basic regression OLS example. You decompose this into this window, all right? So again, we could argue about the window. I've run a bunch of robustness tests over different windows. I'm gonna talk about that at the end of the presentation. But for now, since we always talk about like an 80-20 split between training and test data set, it's kind of a common practice. 10 years, 2 years, we're roughly at about that. It seemed to me like a good starting point. So what's the idea? The idea is you grab all of your data, right, and the training data set from 1/1/2013 to 12/31/2022. You train your model on this, you use the coefficient that you have, and you use that to try to predict the first return on January 1st, 2023. Then once you've done that, you incorporate that new piece of data into the training set, you redo everything all over again for January 2nd, 2022, and so on and so on and so on a rolling window for the full 2 years of your test data, right? So pretty fairly simple setting, I think. Okay, yes?
So when you are incorporating predictions into the model, did you retrain the models, or?
Yes, every time I retrain the model. So, yes, interestingly, right here, since it's a daily prediction, so as you might imagine, with one more additional variable, probably doesn't change a ton. However, over time, right, after 2 years, you probably have a decent bit of difference. Why? Because in addition to this, what I do add to my model, right, is a decay function, which I think is an interesting innovation. I don't think I've seen any paper do that. I mean, they do it in a bunch of traditional finance paper, but somewhat curiously, not really in the world of cryptocurrencies, which I thought was kind of odd, because if there is one, area where things tend to be changing quickly, it seems to me that it would qualify. And so the kind of the idea of using a decaying function, right? Decay function. So you can see the base formula right here, and the little lambda right here is kind of like the factor that makes essentially this curve move. Essentially what it does, if you think about it, is put on more weight on more recent observation. Let's say I have 4,000 observations right here, so it's going to be weighted at 100%. The observation as of 10 years ago, or whatever, is going to have a much lower weight. So again, this is another one of these hyperparameter you can play around with. Of course, it's going to change the weight of your models depending on what decay function you include. But I think it's an interesting little innovation to add to this. So now let's go to the data, right? Because your prediction model is going to be only as good as your data, obviously. So what I've done is survey conscientiously what other folks have done, and essentially, for the most part, what a lot of them do is come up with a bunch of fancy market-based variables. So momentum, spread, price-related values, all of that is for the most part what they use. So I've tried to come up with a bunch of market indicators. I plucked all those that are the most successful, right, from the literature, but I also added to this a bunch of economic indicators about macro trends or interest rates related variables, right? A bunch of sentiment indicators, trend and popularity, and more interestingly, some on-chain data, which is also one of the cool innovations I try to bring to the paper. Because one of the cool stuff about Bitcoin is that it's essentially a public ledger. So what you can do is literally ping the blockchain, so it tells you information about what's going on in here. So you can have information about, say, the number of addresses that are active, the number of transactions that were made, how miner flows or whatnot. This is kind of data that is very delicate to get access to, because you have company that specializes into this. It costs an arm literally to get access to this. But luckily enough for me, I was able to get access to some of these. So I think it's kind of a really good addition to it, right? Because if we're trying to predict Bitcoin price, it seems to me that on-chain action might probably have a lot of information gathered into it. And so roughly speaking, I have like over 200 predictors, so I'm not going to bore you to death with every single one of them, but I came up with like a little simple, summary statistics table right here to make sure you guys get an idea of the gist of it. So as you can see, right, among the market variables, you're going to have, market cap, volume-based variable, turnover, momentum-based stuff, so fairly classic types of variables for those of you guys that are familiar with the finance literature. Among the economics indicators, so S&P return, VIX return, gold, US dollar, Fed funds, 10 years, interest rates, you get the idea. Sentiment indicators, Google trend data, fear and greed index, supposed to capture really how the market is feeling about Bitcoin, especially the retail market. And a bunch of on-chain indicators. So again, I'm not going to go over all of them. They're fairly technical, but at a very high level, what's interesting in here is that you can get information about everything that is related to Bitcoin or the crypto market. How much inflow do you have to and from the crypto exchanges? How many transactions? How many active addresses? How much inflow or outflow do you have straight from miners? This is actually one of those good, very impactful variables that I think is really interesting and useful for the model. So to give you kind of an idea, I've kind of like sorted and ranked like the most interesting predictors right here, the top 20 or 25, whatever I came up with, just a pure univariate relationship between Bitcoin returns and these factors. And so what is actually interesting into it, if you quickly take a look into it, you see that for the most part, those that tend to be, at least at a univariate level, the most predictive, they tend to be by far the market indicators and the on-chain indicators. So that's actually quite interesting and also a good sign because there are so few of these on-chain stuff that are in existing papers that I'm running this, I was like, oh, there you go, it's starting to smell good, right? It seems like we have a couple of new variables that seem to have some predictive power. Good. So now let's talk about the models I'm going to use in here. So essentially at a high level, I'm going to use 3 types of models. Some that are traditional linear models, so base OLS, lasso regression, principal components. Some tree-based models, so random forest, gradient boosting, and some neural network or deep learning models, so typically feed-forward neural networks and long short-term memories. Really interesting and widely used in finance. Thought it would be kind of cool. So very quickly, I don't mean to bore you to death again with a recap of all of these models. I'm sure you guys know what OLS is, okay? So lasso regression, in case you guys haven't really been using it in a little while, it's actually kind of an interesting linear regression that is pretty aggressive in the number of variable and coefficient it kind of kills. In other words, if it thinks that just some of these coefficients are not worth it, it literally just brings them all down to 0. So it reduces the number of parameters that you have. It's a dimensionality reduction techniques, which is kind of an interesting thing. Lasso is actually going to perform pretty fairly well, as you're going to see. Principal components, I'm sure you guys have all run a bunch of things using that. Essentially, you just reduce the dimensionality of your data set by finding components that are common across all of your variables, right? That allow to capture most of the variance and kind of reduce the number of variables that you have, right? So in fact, you see this little graph what my data looks like. I thought it was kind of cool and pretty. Okay, well, we get the idea. So that's it for those very fairly basic linear models. Then we move on to the tree-based models. Those are kind of interesting. This is where we get into the heart of the machine learning thing. So starting with random forest, I'm not sure whether or not you guys are kind of fully aware and familiar with it and how it works. It's kind of a little bit more delicate, but at a very high level, I'm going to try to paint that with a broad brush. What you do is grab essentially a bunch of tiny chunks, sub-chunks of your data and train and run a bunch of models, and essentially you end up kind of averaging them out together in the end. It's kind of an oversimplification, but that's kind of the idea of what's going on. Gradient boosting, very similar tree-based model as well, but you're not kind of running models parallel to one another. What you do is kind of run one, take a look at the error, and just minimize the value loss function gradually. That's kind of what it does. Interesting, those tree-based models are kind of pretty good because they're really good type of quote-unquote, throw everything at me type of model, where you can literally grab your 200 variables, dump them into it, and they're doing a really good job at kind of self-selecting and finding nonlinearities. That's pretty good. So finally, deep learning models. I'm sure by now you guys are getting the gist of it, right? So neural networks are kind of a really interesting thing because essentially what you do is feed your base inputs. Those would be x1, x2, xn. And essentially what neural networks do is that you create a network that is kind of, it's supposed to mimic kind of the way neuron works, right? And so you have different hidden layers that capture a bunch of nonlinear relationships between all of your variables. Long story short, right? Long short-term memory models, same thing, very useful, especially for financial analysis, because you have kind of these gate cells that keep some of the data moving forwards and then hold some others. And so long story short, it's pretty good at capturing relationships over time. So very good for time series, the way we're actually kind of using them in here. Okay. So long story short, once we gone, and I know I took a long time kind of explaining the setup, but it's kind of necessary. The idea is to come up with all of these 7 models and take a look at them, which one performs best, which one performs worse, right? At a very high level, that's kind of the idea. So, without just further ado, let's get into kind of the first few results that I have. Again, as you're going to see, I'm kind of using this session as a brown bag to get some feedback from you guys, right? Because it's a very young paper. I've only been working on that for a few months, but already have quite a few interesting little results. Several different ways you can measure performance. And so we're going to say more about that over time. But at a very high level, if you take a look at it, right, you'll see that no matter which way you choose to measure the performance, you'll see that gradient boosting, lasso, and random forest tend to be like the 3 that are on top on pretty much every single instance. And OLS is last pretty much everywhere. So it's kind of an interesting setup for us. It tends to suggest that, those more advanced and complex model tend to outperform the very base OLS regression. So that's kind of an interesting thing. Same thing with the out-of-sample performance, which I'm kind of proud of, which I'm sure is probably going to make traditional finance folks raise a bunch of eyebrows, because you're going to tell me, but your R-square are like negative for the most part or whatnot. But actually, when it comes to cryptocurrency prediction, it's actually very rare to get a positive R-square, believe it or not, right? So we have a couple that are actually even in slight positive territory. It's actually pretty good. It's about as good as I've seen in the literature, so it's pretty promising. Now, as to why that's the case, well, if you think about it, when we're measuring R-square, what are we doing? We're measuring our prediction versus the actual return, comparing that to a benchmark. And so if you were to plug all of these predictions oh, yes, question.
If you can move backward.
Sure.
Slides,
2 slides.
There we go. I'm curious to know that RMSE value is fairly small here. What is the unit of measurement? Well, MAP is really significant out there.
Yeah, that's got to be I believe the MAP is probably timed by 100, I believe. So that's probably the reason why you have like kind of a gap between the two. But yeah, that's actually a very good point. I should probably harmonize that, because it kind of leads to confusion. You're right. It's kind of it's a good point. I should probably make sure they're all on the same scale. But yes, you're right. It actually seems fairly small at first, especially compared to traditional studies. And part of the reason for that is so it's kind of an ugly graph with everything slapped on together. But what I want to show you is essentially the Bitcoin returns are in gold in here. And as we all know, you have lots of spikes when it comes to Bitcoin returns. You have calm days, but lots of spikes. And so the point is that is, of course, extremely hard to predict. It's much harder to predict something like this than classical returns with much less volatility. And so if you think about it, think about the way your R-square is combined. The bigger the spike that, let's say, your model doesn't capture, the worst your error is going to look like, if that makes sense. So that's kind of the reason why the results seem low, even though compared to the actual literature, it's actually pretty decently good. So now, long story short, okay, before I shoot it, let me just introduce a little bit of context right here. The idea was, okay, so all that is looking good, but can we actually make money using these models, right? I mean, at the end of the day, this is kind of what is interesting. So now, the way we traditionally do this in finance is with multi-factor model, including market models and whatnot. It's very complicated to do this in the world of cryptocurrencies, because like what would the market model be in crypto? That's like almost Bitcoin by itself, so it wouldn't really make a whole lot of sense. So kind of the way I attack that is say, okay, can we compare whatever trading strategy we come up with in here to a basic buy and hold strategy, which is actually in the world of cryptocurrency pretty powerful, because what do we know about them? They tend to be like the upward drift is real, right? I mean, on average, it goes up really, really fast, and you also have very high trading fees. So the fewer trades you make, the better off you are. That's the reason why actually buy and hold is actually a pretty good standard. And so long story short, we do find some evidence of being able to beat even buy and hold, especially gradient boosting, as you can see here, does actually pretty well. So that's kind of the interesting thing, lasso and gradient boosting derived trading strategies actually do very well, especially on this long-short strategy right here. Now, what's also interesting at the bottom is that once you remove fees, and I went up with so dealing with fees in crypto is very complicated, right? Because it really depends who you are. A retail individual is going to pay much higher fee than, like, let's say, a larger hedge fund trading on Coinbase or whatnot. But see here, we have essentially trading fees of 0.10% a trade, and that kills a huge chunk of your performance. It might not look like much like this, but 0.10%, you know, on a day, like if you just do this for 2 days, for 2 years in a row, it actually just literally kills your performance. So what's interesting is that despite looking at this, where we do create value with the gradient boosting strategy, in fact, if we, so yeah, I have long short and long cash, right? So essentially going long short Bitcoin depending on the predictions, right? Or long cash, the reasoning was that since essentially on average we go up so much of the time, maybe it's actually not a great idea to short, right? You can just simply just go cash. It works better if you go long short, interestingly. And over a longer time horizon, here we have it's an average of different 3-year time horizon that I run here from 22 to 24. You can see that it significantly outperforms buy and hold, like by a wide margin. In fact, after taking away the fees with the gradient boosting trading strategy, you kind of 10x your money, right? So that's an insanely large performance. Right? So what's the long story short of looking at it like this? It's kind of messy. The vast majority of these techniques failed, especially after you take fees into account, to kind of beat a basic buy and hold strategy, which is, again, it's a high bar in the world of crypto. But we have a couple right here that actually fairly significantly do. Yes?
So when we look at the cumulative returns, there are a couple of times it goes below the zero. And below the 0 point.
Oh, yeah, that wouldn't even work. Yeah, you're done. You lost everything. Yes,
and
you're absolutely correct.
That is a point, for example, a couple of investment just trashed, and you
Yes.
need to put capital back.
That's right. You need to put capital back to maintain it. In here, I just kept it as if, because either way, these trading strategies are no good. So, but you're right. Technically, you'd crash or you'd have to re-inject capital after 0. That's an excellent observation. You're absolutely correct. I kept them because essentially what I wanted to show is like the 2 that actually worked. Those are like the ones that you kind of want to show, and they are actually fairly efficient. So now it sounds a little weird when you just graph a bunch of things with different colors right there. It's not necessarily the most intuitive. So what I've done is kind of compare the models to one another, and more interestingly, I guess what I've done is also run a very basic test to check out whether the predictions are random, right? Because at the end of the day, what are we looking at? We're looking at, as you brilliantly exposed at first, it's either a buy or a sell. So it's a 50-50 proposition, right? So the idea is to say, okay, what's the percentage of positive and negative predictions that are made, and how many of them are correct on average, right? So it's kind of an interesting thing. So I laid out all the numbers to be fairly transparent, but the last 2 columns are the most interesting. If you take a look at the total correct predictions for XGB and Lasso, you're at over 56% on the daily. That is actually pretty darn high compared to most of the literature. So you're starting to creep into a territory where you're definitely, so what the p-value is testing is it different from a random coin flip? That's essentially what we're testing, a 50-50 proposal. So these 2, yes, it does significantly better than picking one or the other randomly, right? And so I know, again, 56% doesn't sound like much, but maybe for those of you that like sports betting, you probably know where I'm going with this, right? Let's say you're betting on whether or not Pat Mahomes is going to toss, I don't know, 2 TDs or 3 TDs next week. It's a 50-50 proposition, right? You either go over or you go under. It's one or the other. So if you keep on betting and instead of having a 50-50 proposition, you have a 56 point whatever or 36% proposal, you're actually going to make a lot of money at the end of the year if you keep on doing this. So the point is that it doesn't look or sound like much at first, but it's actually pretty good once you start passing the threshold. So it's kind of interesting, at least for these 2. I was not as successful with a bunch of other models, so there might be a bunch of reasons for that, but interestingly, it's nice to see that especially gradient boosting does a great job at that. Part of the reason why I think it's probably because it's one of these models that is great when you throw a bunch of things into it, even though some might not necessarily have the greatest correlation, but it's interesting, yes?
So in the beginning of the presentation, you mentioned that you've got the predictions and use this prediction to train the model.
Yeah.
And you train the model over autoregressively based on the prediction made by previous models.
That's correct, yeah.
But in the reality, when we
I'm sorry, not on the previous models, just on itself. Just one by one by one by one. That's it. I'm not sure if that's what you're asking. Yeah. Not all of them, just one. Yeah.
Okay,
one by one. For each one, just itself. Yeah.
you train from new models with the actual data.
Yeah.
Okay.
Yeah, that's right. Trying to make sure that this is actual observations that you would have if you were to actually do this tomorrow. In other words, can I really trade using this tomorrow? And that's an interesting thing because it seems to suggest that you would be making money. So again, the big caveat right here would be the fees, right? Again, for an average retail individual, if you're taking a look at the fees, say on Coinbase, they're like so gigantic that it would probably take on much more of your performance. But if you were to have, like the way they structure it is, it's all a matter of volume. If you trade past a certain volume, they lower your fees quite significantly all the way to zero. But so you would, if you were to have, if you were to be an individual who is able to trade for a significant volume over several months in the hundreds of thousands of dollars, you could conceivably bring the fees even lower than that. And so that starts to be really kind of an interesting thing. So long story short, kind of an interesting stuff. What I think I do is kind of bring a pretty fairly base setting saying, okay, let's do what I believe is probably the most intuitive way to try to tackle this problem. Let's try to predict returns tomorrow. Again, might try different windows, do X, Y, or Z, but I think at the very least it's intuitive and it's a nice comparison of all the models out there. And so bottom line, what do I find? I find that there is at least a couple of these models that perform really well, especially gradient boosting appears to be doing a really pretty good job. And as it stands, it seems to be something that you could, backtesting it would have been very successful over several periods of time. So I've just shown you a couple of periods of time, right? 2 years, 3 years, 4 years. I kind of tested that like, left and right. It does take a lot of time to rerun every single model, as you might imagine, but it's pretty resistant to the time window thus far. So it's kind of an interesting thing, and that is where I am at right now. So this is the reason why I was happy to present that to you guys, because I'm really taking any and all suggestions. My roadmap for now is to kind of course, test the famous crypto three-factor model. I have my own problems with the crypto three-factor models, but I do think it's a very interesting thing to add to this. What I also think is really going to be interesting is to be able to try to add a second module that predicts catastrophic losses. Because I think, as you were mentioning, we've seen the whole thing going even below zero. That is actually the key. If you can avoid these days where you lose 30%, mechanically your performance would shoot up tremendously. So I do think that there's a lot to be done into that very specific segment, avoiding really the extreme downside. I haven't worked on that yet, but I do think it's probably a really interesting avenue. The last one is also leverage as well. I have not really explored that much beyond like shorting, but those would be interesting avenues. Yes?
For predicted catastrophic losses that below the zero, there might be some interesting idea or roadmap or some exploration. Imagine right now we have two models. One model is predicting these return, another model is predicting these 0 points on return.
Yeah.
And it's going to be meta learning ensemble model. Your base model is going to make the predictions, and the meta learning models, ensemble model, or meta learning model is going to predict only whether it's going to be actually 0 or 1. Maybe second layer modeling on the catastrophic losses.
That's a good idea. That's a good structure for sure. It's interesting. That's where it's starting to be really interesting. How do we model and structure this? That's really where it's a good idea. It's a good idea. I need to think about it some more. Thank you for that comment. Any other question or comment or anything, by all means, feel free to have at it. I think I'm within the 45 minutes window. We got to be at 45 right now, so sorry I sped through it, but I wanted to make sure I didn't waste anybody's time. Yes?
I have more of a story question.
Yes.
Do you find that chain variables, there's a lot of them that are actually
Yes.
significant. So has that been looked at before, or is this your major contribution?
Very sporadically. That's one of the major contributions. Some include some of them, the very basic ones that are easy to access, number of addresses, number of transactions that are really not too hard to grab, right? Now, I do have a ton of them, or including some of those that you saw in the univariate, that are much more difficult to grab. It's like I got it because I know a guy that works in a private company that collects data on the blockchain. So that's actually how I ended up getting this. So it's actually kind of pretty cool because it's hard to actually put your hands onto these. But yes, as you saw, they actually do have some predictive power. So that's kind of an interesting thing I do add, yes.
So what is some explanation for that?
What do you mean?
They have the predictive power, right? It's
Yeah.
interesting that people haven't looked at it, but it sounds like it's hard to find that data. But what
Yes.
are some of the explanations that you
for them. That's actually a great cue. I have not really focused a whole lot on that past the whole miner thing. That is actually kind of really good. This is really the data that I wanted to have from that specific source, because what they do is that they're able to identify essentially miners, right? Which, believe it or not, is actually not super easy to do because they have lots of wallets. So having the database of which wallet is whose is actually a very valuable thing to have. And so once you have those miners' address, you can take a look at their inflows and outflows to and from crypto exchanges. That is one of those that is the most significant, and to me that I think makes sense, because if you think about it, what are the miners? There are guys that are going to hoard tons of Bitcoin. So usually when they, for example, shoot some of their money to crypto exchanges like Coinbase, why are they doing this? Because they're trying to sell it, right? So if you're just merely looking at this inflow or outflow, you probably have a pretty good indicator of what's going to happen over the next day or two, if that makes sense, because you've had such a large inflow or outflow of money. I believe that's the reason why they're so predictive, because I've seen that it's mostly the miners related one that pop in that table. That is also what caught my eye, because you saw just a few of them. I have like probably hundreds of on-chain variables, and so these specifically appear to be the ones that are driving most of it. A couple of others are more like market related, like the thermal caps or whatnot. It's kind of a weird metric. It's taking a look at Bitcoin's market cap, but also dividing it by all the block subsidies that have been received over the past X months, and so that kind of gives you a ratio. You have a couple of measures like this that are also very predictive. I have not fully kind of wrapped my head around why that is, right? That's part of the story-related component that I need to work on, but you're right, it's a pretty good question. The minor part, I do think I can explain that. The rest, I'm not super sure still. My base approach initially was more or less to kind of dump everything into the model and kind of see what happens. To a degree, I probably shouldn't say that, but yeah, we all kind of process that way sometimes. So yeah, it's kind of the idea. Thank you for the question. Yes.
Minor concerns. Before I see this page, actually, my first question would be why you should predict the return instead of just buy and sell, because most of this machine learning models they use to predict buy and sell signals instead of predict return. So this is one thing you want to do. And the second, for the models, when you do the traditional one, you use Lasso. Why pick Lasso? You have Elastic, you have Rage. Lasso normally shows the lowest performance when you compare with Elastic or
Yeah.
the other ones.
That's a great question.
Because it's a whole group.
There's a whole group. It's a great question. I hesitated in between a bunch of them. What I actually found attractive in Lasso, which is going to sound a little weird, but it's the most aggressive at reducing the number of coefficients. And on some of these models, so typically I also think that's probably part of the reason why neural network and long short-term memory don't perform as well, is that they are not as great as killing noise, if that makes sense. And so part of the idea of taking Lasso is that it's going to be the most aggressive, shedding all of these variables that are not as useful, and essentially to kind of use that to feel that reduced number of predictors that actually have predictive power into those later stage deep learning models. That was actually mostly my reasoning for using Lasso as opposed to another. But your concern is really valid. I could add a bunch of others. I guess my priority was to add more deep learning and tree-based learning models as opposed to the most traditional ones. But it's a very valid concern.
Yeah, it's because for your forest and tree-based learning models, it's more useful for grouping, which
Yes.
is more useful to predict the buy and sell signal instead of predict return. Another thing is for LSTM model, did you standardize all the variables before?
Yes, all standardized.
Okay,
Yeah.
yes, because that is another concern.
Yes, you're right. Otherwise, the scale would be a real big problem. Yes, you're right. That's something that I didn't mention. So you're right. Thank you so much for the comment. Yes, everything is normalized.
I'm not familiar with Bitcoin, but in the traditional finance, there's recent papers about machine learning, especially how the sentiment can influence the stock prediction in the future.
Yeah.
Recent two papers look at the overnight sentiment from ChatGPT or some other tools to predict return. I think I saw a paper before about overnight sentiment predict the Bitcoin stock price, Bitcoin price in the future. Do you
Yeah.
consider that kind of thing?
Yeah. No, that's a great question. The market sentiment thing is also a pretty good component. It's admittedly the one that I have the fewest components on, simply because they're actually kind of tough to get for all of these years. What I had thought about doing was kind of silly, but just grab all the tweets that involve Bitcoin every single day. I thought that's probably kind of a good measure of, it's kind of hard to tell whether they're good or not, but you could combine that with essentially a bunch of sentiment analysis. The problem though is that it's outrageously expensive. I don't know if you guys have tried to actually get anything from like, I had no idea. That's the first time I would ever use anything that comes from Twitter. So I just reached out to them. And so for the historical data, they think will give me a quote like $70,000 or something. It's like, okay, I'm most certainly not going to do that. But yeah, it's interesting. So yes, it's a great point. I was just mostly unsure what to do about it. My second instinct would be to just take a look at Reddit. Maybe that there's also some information into this. I'm still a little mad about that because it feels like Twitter would probably be very good because, you know, every single guy that was like is probably going to tweet something about it. That would have been my guess. So to capture specifically this, it seems to me that it probably would have done the best job, but unfortunately that's kind of off the table. So if you guys have a suggestion as far as that's concerned, I guess Reddit was my number 2, but I'm not sure. I'm not sure what to do. But you're right, it's a very, very valid concern that I'm sure would probably add some actual predictability. It's a couple of great points. Thank you so much, guys. Any other question or suggestion? Yes?
The first one is about the debate function that you introduced.
Uh-huh.
Well, in our field, we use RMX for that to include the, memory of past patterns. And how is that different from RMX?
It's actually a good question. I'm not exactly sure. It's a good question. It's a good alternative. It's one of the latest things I implemented. Most of the recent, finance literature tends to use a decay function that is similar to this. It hasn't really been used, actually, surprisingly, in the crypto literature. Granted, there is like far fewer paper on the crypto side of things than there is in the traditional finance part, but I mostly used it because I thought it seemed to be like the most natural, smoothly way to account for that. But this is a pretty good point. I haven't tried any alternative way to just account for that. But that's a good point. Yeah. Yes, that's a big chain. It's a very good point. That comes also with a caveat, which is that stat holds especially true when you involve non-Bitcoin cryptocurrencies. And here's the reason why. I mean, it's still extremely high, even with Bitcoin, right? It's probably not 99, just 90%. So I guess the concerns kind of remain valid. But part of the reason why that is that that's kind of the initial cryptocurrencies, and you have so many random guys out there that got to mine some of it or to get some of it early that it's, to a degree, by crypto standards, probably fairly well distributed, right? The reason why there's the 99% owning so much of it is that for all of the remaining coins that have popped ever since, there's a lot of private money, there's a lot of venture capitalists backing some of these. And so, for example, maybe some of you guys have heard about Solana. That's one of these like super famous coins. And I believe that the original VC firm still holds something like 94% of the entire supply, and that's just for this one firm, right? That doesn't even account for like a couple of other large whale holders. So I'm not sure how high this takes us, but you're right, probably pretty darn close to 99% would be my guess, which is also, if you're an amateur investor, something that you should really worry about, because the day that these 99% holder decides to dump pretty much everything, there's only one direction in which the price is going to go. But so that's kind of a concern that is especially present with the others current cryptocurrencies, a little bit less with Bitcoin. So again, compared to traditional, finance standards, it is still a high concentration asset for sure. That's completely true, but probably a little bit lower than benchmarks strictly for it as far as that's concerned. But you're right, it's actually one of the reasons why, you could conceivably fairly easily grab just price data and on-chain data for a bunch of other cryptocurrencies and dump them into the whole thing. But my read on some of these papers that take a look at more cryptocurrencies is I always wonder how much of that is driven by Bitcoin. That's part of the whole thing that I had by, was thinking about including all those crypto factors. But when you have the crypto market factor, how much of that is Bitcoin? I mean, by itself, it's got to be like 80% of it at least, right? So it feels like you're kind of comparing an asset to itself almost, right? So I don't know, I need to think a little bit more about that. I'm not quite exactly sure how to handle that problem as of yet, but very good point and very valid concern as well. Thank you. Lots of actually really good remarks. Thank you so much, guys. Is there anything else, by the way, while I'm at it? I'm making good mental notes of all of that, so. Yes?
So let me approach this from what I know, and that is question everything that Washington D.C.
Okay.
Morillon and Pancake. They used convolutional neural network, long short-term memory, temporal convolution network, Garuda. all this stuff. Their conclusion was that they achieved an 82% accuracy. When you started talking, you were saying 60 is high.
Sure. So that's the reason why 80% accuracy, but what type of accuracy are we talking about?
The three trading strategies and three investment decisions are examined through back testing. The long and short buy and sell investment approach generated an extraordinary annual return of 6,654.
Okay.
Again, I'm
Sure, no, yeah.
not from an investment decision, but from a bullshit perspective. and so I'm thinking about this, and I'm thinking about your predictive models, and as I understand it, and all I do is invest in large caps. So as I understand it, the only value of Bitcoin is what people think it's worth. And that's it. It's not backed by
Yeah. Oh,
anything else, no assets, nothing like that.
that is 100% correct.
And then I think, David Sachs, who is the grandfather of Bitcoin, is now in Washington, D.C., and he's convinced the President of the United States to put some $17 billion in reserves for Bitcoin.
Okay.
And then after that, he decides through his family's investment company to create his own cryptocurrency.
Oh, of course. Yeah.
So here's my question for you. Because when the president put Bitcoin reserves, that shot up the price, but then it came down, right? And to my friend over there who says 1% got very wealthy within 2 days, sold and got out, but not David Sachs. And so my question to you is, these models that you're trying to predict, how do they include two factors that I still don't understand how machine learning can predict? And that is human greed and politics. So how do your papers, or all these papers that are trying to predict, how do they play into a role where what really is going on is not so much Wall Street, but DC?
It's a fantastic question. There are so several elements to it, so let me address them kind of one by one. The first one is, how can a machine learning algorithm predict human greed and the whole politics aspect of it? The simple answer is that it probably can't. That's simple. Essentially, otherwise, if I were to be able to predict most of the price movements and the politics behind it and human greed, my prediction rate would probably be at 99%, and I'd be Warren Buffett. So that's kind of the long story short. Now, back to your second question as far as to the ethics of, let's phrase it like this, of propping up something, creating your own company that trades it. Oh boy, I cannot agree more with you that it's, I guess, I don't know, shady is probably the first adjective that comes to my mind, right? Now, that being said, also when it comes to the Bitcoin reserve, that was kind of a very interesting moment because I remember reading an article about it. What I think, for the most part, happened as far as the up and down went is that initially we heard about, Bitcoin strategic reserve coming around, which seems like it's positive news. So that would make sense to see a bit up in the price. And then eventually I remember seeing an article where Mr. Sachs was talking about essentially not buying anything, but simply not selling what they have seized from criminal. I'm sure you might have read the same thing. I'm guessing that might be the reason why we saw the second leg of that train going down, because initially when I heard there's going to be a Bitcoin national reserve, my guess was it's probably going to be extremely bullish. Why? Because the United States government is going to start buying actively Bitcoin. So if you think about it, right, we're mentioning about how much Bitcoin is in circulation. If you have a very, very large buyer like the United States that starts really actively scooping up and buying a bunch of Bitcoin, the price pressure onto the upside is gigantic. And now a few days later, you're telling me that essentially you're not going to buy anything. You're just merely not going to sell what you have already seized. Does that make sense? So I'm guessing the expectations of the market all of a sudden fall right back flat. Does that make sense?
No, it does, but actually it's the inverse. Because if the government is not going to back it with taxpayer money, but they're only going to do it based on DOJ and FBI seizure of assets by criminal components, which are the majority of the 1% holder, right? All you're really doing is you're taking out one cartel and making another cartel powerful. That's it.
That's a very valid criticism.
If that's the case, then it would be the inverse. We don't want to buy more because the point is to make the 1% richer, David Sachs. And therefore, we're going to use the arm of the government to seize cryptocurrency. holders actually have more worth. Because you told me in your presentation, one of the reasons of the value is because it's limited.
Yes.
Only 21 billion. If that's the case, you want the government to seize all these assets, cryptocurrency, Porsches, houses, girlfriends, take them out of the market, and now you make the Juarez cartel more powerful than the Sinaloa cartel. It's all the same. It's just you call it Bitcoin, I call it a criminal enterprise. Am I okay? Am I hearing you correctly? That's what, as a journalist, I don't understand that.
So that's a pretty good, interesting, and sensitive topic. So essentially, what you're arguing about it is let's call it. I'm going to call that the ethics of what's going on. All right.
That's what I teach.
That's makes sense. I would agree with you that a lot of it, if you're asking me to explain why Mr. Sachs is doing what he's doing, who he's in business with, who's holding what, my guess is that I have no idea. I suspect that you might be right. There might be some funky business going over this, but I personally have absolutely no way to figure that out. I can't. The only thing that I can do is try to predict, is my stuff going to go up or down based on what is measurable? And I guess that's probably the key right here. You can only just predict something that you can measure, if that makes sense. I can't measure what connections Mr. Sachs has, right? I'm guessing he has plenty of them, I'm sure, right? But there's no way for me to formally measure this, right? So it can't really enter my model. Now, I understand your point. It would probably be even more efficient. I could probably increase my prediction percentage of success if I were to be able to measure that, probably in all likelihood. But I'm not sure how to go about it, right? So from my perspective, what I'm trying to do is only kind of to a degree control what I can control, if that makes sense. And that is literally looking like a good old little nerds, all of my numbers, what's going on in and out of the chain, what's going on in it, and what are my market variables. That's mostly what I focus on. Now, I understand your question when it comes to the ethics of the whole thing. Very hard to tell. To be honest, I'm kind of sometimes at a loss when it comes to following the latest moves of the government as far as the reserve, non-reserve, reserve, non-reserve. It seems to be like a very up and down to me. I would probably think that it's probably by design in many ways, right? If I know that I announce something and something's going to go up or down, I can probably make it nice a little bit beforehand. But beyond that, there is not much I can do about it or say anything. So I'm not sure. Maybe that doesn't really address your question, but yeah.
I want to know how we can use these models for other things, news predictions. That's what I'm trying to.
I just want to add something to your argument. I really agree with you. I'm also from the finance department, so let me go with this. I'm working on a project right now with a student. What we try to do is we try to use the political uncertainty to predict the stock return. Okay, special kind of things, right? Because, based on our argument, it should be a free market, high efficiency. No political policies or sentiment should impact the stock price, but in reality, we do. If we figured out, yes, the political uncertainty can affect some kind of groups of stock prices significantly. So our argument is how, if we can somehow use the machine learning model based on the historical political uncertainty information to predict the political uncertainty in the next month or next day, so that we can use that information to predict the stock price. We try so many different models, we cannot. Okay? There's no way you can predict political uncertainty even for next day or next month. And it's even getting worse with Trump. Okay? So, interestingly, we can still use those information for two things. One, for the performance evaluation. Because you know what happened with political uncertainty in the past several years. So you can use this information to explain why you get a high return or low return for those kind of stocks. And second, you can try to do something if you can somehow have your own opinion about the political situation in the future. For example, my personal portfolio, I hold the majority of cash right now because I really don't trust this new president. Okay, I'm gonna hold for a long time. So those are the two major things you do. But for the prediction models, no, it's really hard to incorporate those things into the model because those are typical classic finance models. We only assume there's efficient market, and we really cannot do anything with that.
And I'm being serious when I ask this question. Would it be possible to take the mob wars of the 80s in New York and then put all that into a predictive model to predict what Trump would do in the next 3 years? Like, could you take he lived in New York during the mob wars, what lessons did he learn that could predict predict politics? Would that be possible?
I will just add something about that. It's not necessarily maybe possible because we are human, unpredictable. And when we are predicting uncertainty, it's inherently unpredictable because you're predicting uncertainty, the raw noise that you are doing it. From the mathematical or modeling perspective, that might be very hard. However, there are some glimpses of hope. Recently, there was a research, maybe Sue aware of it, that they train 45 hours of people's background and informations, and they try to mimic that person's personality, and they reach very high accuracy on the AI, which means you can just put all of those information into one of the AI models, generative models, and train as Donald Trump, and that model may act like the Donald Trump and make a decision like a Donald Trump. That is a possibility to mimic humans through these AI agent, but still is not so developed and nascent. So, by the way, I just want to thank our presenter. Please join me. So we are keeping the rest of the time, 15 minutes, 20 minutes, open networking. If you want to reach out to other people, if you want to come ask questions to our guest speakers, please feel free. And thank you for joining us, and see you around.
Thank you so much, guys.